We're half an hour from the open in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Avril Hong in Singapore.
Good morning, and I'm David Ingles in Hong Kong. Let's get to your top stories today. Stocks across the Asia-Pacific are trading with a hint of caution after a pickup in U.S. wholesale inflation has traders reducing expectations and bets on Fed rate cuts. We have Chinese activity numbers set to come out in the next hour, set to show the economy still under pressure. Now, Beijing said to consider asking companies owned by the central government to buy unsold homes from distressed developers. And also ahead here on shows today, Bloomberg reveals the Trump administration is in talks for a potential stake in Intel. And Vladimir Putin praises Donald Trump ahead of their summits in Alaska, dangling the promise of economic cooperation and a new arms treaty. Right, a quick glance at markets as we wrap up the trading week. A full trading session, of course, is still ahead, and we are slightly on the front foot with the Nikkei 225 up 0.5%, Taiwan coming online, and within that market, of course, we're looking at Hesai following the earnings that came out, of course, late yesterday, I should note that. 0.25% to the upside there on the MSCI Asia Pacific. Lots on deck today. We have a ton of GDP reports across the region. We've had Japan, we have Malaysia coming out, revision in Taiwan, Hong Kong, and Macau are also on deck today. On top of that, and in between that, we have new home prices coming out this hour in China, and of course the monthly activity numbers at the top of the next hour. Fed conversation, PPI, not just coming in above expectations, blowing past every single one, more than double, in fact, the highest estimate there, perhaps reducing the fully priced past tense expectations around the September Fed meeting out of the Fed, a cut there. Still, though, that is still the base case, as you can see on the screens, though. The 10-year yield in Australia is following the move up in treasuries overnight. Right. Speaking of a melt-up in yields, ever so slightly, but ever so consistently, the Chinese 10-year yield is now trading at 173, a level we haven't seen, by the way, in about 2.5 weeks. So we'll track that closely if that continues well into the session today. 30-year bond yield as well on your screens now has a 2 handle on that. We are looking at declines going into the open today, and I should note these are fairly steep declines. Avril being priced in ahead of the open, 27 minutes away.
Yeah, really going to be keeping tabs on that GDP data out of Hong Kong, Macau, but as you say, the mainland as well, and against the backdrop of yesterday, we saw that stock rally on the mainland taking a bit of a breather, and turnover, interestingly, actually topped 2.2 trillion yuan. So this is the highest this year, going past the DeepSeek moment even earlier in the year. Aside from that, a couple of stocks we're keeping tabs on as well. JD, after its revenue beat, its profits were a miss, though, so we'll unpack that on the program. We also had CK getting hit by a one-time, that was the merger-related costs, and the profit plunge there. Weibo, another stock we're watching. Sands China, and then, of course, the IPO boom in Hong Kong, and we're expecting to see the start of trade for Innogen pharma. And then, because of the bad weather, interesting, yesterday also we saw how the national security trial of Jimmy Lai was delayed, David.
Yep, lots on deck today, as you were pointing out. On the pharma listing, 5,000% oversubscribed, of course, as far as the retail tranche is concerned. And the CEO, Wang Qinghua, will be joining us on shows later today, as well as we'll be unpacking the eco numbers with Barclays. And, of course, also on earnings, David Lee, boss of Hesai, and Jacob Kam, the outgoing, of course, and he's set to retire this year, boss at MTR, joining us throughout the shows today. Avril.
Yeah, in the meantime, the other big story we've been tracking is how Bloomberg has learned that the Trump administration is in talks with Intel on the U.S. government potentially taking a stake in the company. For more on this scoop, let's bring in senior tech editor Nick Turner. So, Nick, this is quite a turn of events. I mean, we've seen how we went from Trump talking about Bhutan, that he should quit, to them having an interesting conversation, to now potentially the U.S. taking a stake in Intel. What do we know?
Yeah, I mean, that meeting between the two men, I think, set the stage for this potential plan where the U.S. government would take a stake in Intel and help support, in particular, this factory expansion in Ohio that was once touted as potentially being the biggest chip-making facility in the world if it was completed.
Okay, and the prospects of that, Nick, David here, by the way, thanks, by the way, for staying up for us and staying up for us here. 7% in the markets right now, the probability of this one going through and what it means for the longer-term strategy of the company here, Nick.
Yeah, I mean, obviously Intel needs help, and this is a few different ideas have been floated over the past few months. One included TSMC potentially running their factory network as part of a joint venture. That didn't come to pass. So this is an idea that I think appeals to investors, as you're seeing that as the Intel gets some money from via the stake, and maybe in return we don't exactly know the details in terms of what it means for that Ohio factory, but presumably you have to think maybe it accelerates the expansion because currently it's not supposed to even open until the 2030s, so it's a ways out.
Nick, thank you so much. Nick Turner there in San Francisco for us, our senior tech editor. Right, to the other stories we're tracking today in China, this expansion in industrial output may have actually slowed quite sharply. Last month, you have heavy rain, you have hot weather, and you have heavy rain separately disrupting factory and mine operations, while the government has intensified, of course, efforts here to rein in excess capacity. For a preview of the numbers coming through today, Min Lo, our China correspondent, is here with us to just help us understand the context of these numbers coming out.
Yeah, we are expecting a miss on pretty much, well, we're expecting a slowdown in every single metric of the activity data coming out today. So industrial production expected to slow to 6% versus 6.8% the previous month, and retail sales 4.6% versus 4.8% the previous month. And this, if it comes true, it will be the slowest growth in 5 months. And property investments, fixed asset investment as well, expected to slow down, as you can see on the screen. And there's been many factors that has been hanging over the economy, right? There's, of course, the trade tension that is making businesses a little bit more cautious about investment. And of course, the anti-involution campaign that is now in full force, the Chinese government trying to cut excess capacity in sectors like coal. And you also have the weather that was an unexpected drag on the economy, because not just the unusually high temperatures, there also was heavy rainfall, floods at different parts of the country that disrupted factory activity, disrupted construction as well. So that's a drag on fixed asset investment as well. Consumption, we're still seeing consumers pulling back despite those government subsidies coming through. We expect to see home appliance sales holding up, but then maybe the bad weather as well, keeping people at home rather than going out whining and dining. And you combine that with the credit data that we got earlier this week, it really is showing us signs that the economy is slowing down.
And it also speaks to the need perhaps for some property sector support, right? We're hearing about how China is mulling getting these state-owned enterprises to mop up unsold homes. How significant is this? How might this move the needle on the property crisis?
Well, if you're listening to Christy Hang, who is our Bloomberg intelligence analyst, she is saying that it's not going to move the needle at all. But I still think it's a pretty significant move, because over the past few years throughout the property crisis, we have seen how Beijing has pretty much left it up to the local governments, the provincial governments to manage the crisis, even as they inject liquidity through the PBOC. But this time they are now mulling, according to sources, letting SOEs owned by the central government as well as bad debt managers to step in to mop up these excess housing. There are about 60 million of these unsold apartments on the market that could take years to clear up without government intervention. Now, the SOEs are going to be allowed to tap the 300 billion yuan in relending facility introduced by the PBOC last year. And if you recall, that program had seen very, very low take-up rates so far. Only 6% of loans have been approved. And that's because the fundamentals are weak. You take a look at the chart, it shows housing market is still slumping, right? Home sales, home prices continue to slip, and your rental yield as well is quite low. It doesn't make business sense for local governments to pick up, these apartments and turn them into affordable housing. That's the reason why Christy Hang is saying that this will not really move the needle. But still, it is a sign that the government is perhaps acknowledging that the existing measures so far are not enough. And for the first time, they're allowing these state-owned companies from the central government side to step in. And of course, this is still, according to sources, not confirmed by the government yet, but still a significant move forward.
Min, thank you so much. Min Lo, our China correspondent there. Just over 20 minutes away from the opening bell here, and we are looking at declines already right now, 0.6 of 1%, depending which futures you're looking at here. I'm looking across the board. It doesn't seem to be the usual names like Tencent is flat, CK Hutch, earnings yesterday. Alibaba, though, had quite a tumble overnight, 3.6%. That might be, and we're looking at indications here, in and around a 2% drop in shares of Baba going into the open today. We'll get you that and more coming through here on The China Show. Good morning.
All about earnings. China's Hesai Group has reported second quarter earnings with net revenues soaring 54% on year. The company is the world's largest maker of LiDAR sensors used in driver assistance systems. It also just announced a new deal with Toyota, which will feature Hesai's long-range automotive LiDAR in a new model. Joining us exclusively now in Shanghai is Hesai Tech co-founder and CEO David Li. David, really good to have you with us after a set of bumper earnings. Talk to us first off what drove this and how you're looking to build that going forward, especially given the China business.
Morning. Thank you for having me. It's a very interesting earning results because we're actually finally seeing the takeoff of the volume. And I think the first thing I wanted to explain is it's actually about safety, 100% safety. It's regulation. The government decided that, look, there's too much of the clarification needed for the definition of level 2 and ADAS. So then what they decided to do is that they were like, look, you know, in the past, of course, level 2 is on the driver, but it doesn't mean that anyone can just claim this is a level 2 system. So they came up with the tightened rule regulations on what you could call ADAS and with a set of scenarios. What's very interesting is that we're seeing that in some of the scenarios, I believe it's virtually impossible to do without LiDAR. That's why the industry is seeing the transition into 100% take rate for LiDAR. We're seeing this trend. And remember, in the past, LiDAR is something you use and then you get additional functions on ADAS. Now it becomes the safety parts, like the invisible airbag. Now, when you use LiDAR, it's becoming safer, it's meeting the regulation, and that's why we're seeing a lot of the customers already are transitioning into 100% take rate on LiDARs. This is a very interesting transition. And that's one of the biggest reasons that it's driving up the volume.
How much further growth are you expecting in volume in the coming quarters?
Sure. Maybe we should talk about how far we've done, right? And if you look at it, the actual numbers, I believe it's very impressive. For the first half of the year, we've shipped more than 500,000 units. That's already more than how many we shipped in the entire year of 2024. And if you look at Q2, the total shipment is 4 times of what we were a year over year. And that's the reason we're reaching GAAP profitability for the first time. And then we're also diversifying our customer portfolio. Used to be more concentrated. Now we're working with really almost everyone. And now we're the main supplier for Li Auto, for Zeekr, for Xiaomi, for BYD, and many, many more like Leap Motors, Geely, Great Wall, Chang, and Chery. So we're working with all of them. And then with some of them already also coincidentally, maybe also not so coincidentally, doing 100% like Li Auto and Zeekr and Xiaomi, and also BYD's Gazais for A and B platform. So that's why we're super optimistic that this trend will have to continue to make LiDAR the standard configuration for the level 2 ADAS system. We believe this trend is already happening.
David, on the volumes question, I mean, certainly it's a good problem to have that the mass adoption, I think, just to how you describe it, is taking place. Yeah. How are you thinking about manufacturing capacity? Do you have enough capacity to meet demand, you think, over the next couple of years?
This is China, right? Like, it's really usually not the biggest challenge. If you think about the product itself, right, the design is mature. So we've been doing copy and paste, right? Each of our line is 500,000 units. All we need to do is just to copy and paste the production line, which isn't a challenge. Apparently, we also have abundance of people to operate that. The only challenge is that we usually tell customers that we need ideally 6 months, but definitely more than 4 months heads up if you need to greatly expand your volume, which we usually get because in the automotive business, it's sort of predictable within a few month period. Of course, the other reason is that because we're almost becoming the index of the ADAS industry. If you think about it, we're working with almost everyone now. So we don't have to rely on the prediction of the specific customer. We're really just relying on the overall industry status, for which we have better certainty to plan, and also we have less volatility because we essentially are averaging out their variabilities.
Yeah, David, you mentioned great way to put that. In China, it's not a problem in terms of increasing capacity. The reason I bring that up is there have been reports of you guys looking at capacity outside China, perhaps your first overseas plant. I'm talking about Southeast Asia here. Wonder if you could comment on that, where you are as far as that plan is concerned, and where in Southeast Asia?
Maybe first, the reason is not because we're running out of land in China. That's not the reason we're going to Southeast Asia, right? It's because for the global OEM we work with, we announced that last earning, and we have to have outside China facility to support their volume outside China. So that's really the reason. And we signed a lease of that factory in Southeast Asia, and it's in the process of being built up, and it's a retrofitted factory, it's a brownfield, and we are in the process of building up the capacity. And we expect this factory to be up and running by late 2026 or early 2027.
So no indication yet of where exactly you can share with us this factory might be in Southeast Asia?
It's one of the usual suspects with great food.
Okay, David,
it's Malaysia then. I'm kidding, Avril. Go ahead.
Well, this is your preference. Some people might disagree.
Yeah. I mean, aside from the supply side, I wanted to ask you about, the landscape in China, because we know how Huawei is kind of dipping its toes into the LiDAR business as well. You talked about how regulatory clarification is really helping, lift the hood. So is this a market you think that is big enough for everyone? How are you thinking about competition?
Yeah, there's always great competition, especially in China. But I think what's interesting is that I think what you're implying is that because of the competition, the gross margin and everything might not be the greatest. And that's actually true, especially in China. But what's interesting is that we always tell people we're not a car company. We're not even a car supplier company. We're actually a LiDAR company, and we build LiDARs for all different industries. For example, if you think about the other topic, which is robotics, when we talk about robotics, it's a completely different industry with very different ecosystems, but they share the platform technologies of the LiDAR from the ADAS, which we are super good at the quality, at performance, and the cost. So then we apply that to really many industries: the robo-taxis, the robo-truck, last mile deliveries, lawnmowers, and service robot, the cleaning robots. And this quarter, our shipment for robotics industry has gone up year over year by 8 times. I had to look up the word. It's octuped, and which is very impressive. And we already shipped more than 100K for the first half. And that's what we're seeing with the new growth and it's much better margin business. It's serving all different industries, and it's an equally good product we're serving the ADAS, which much better price. And if you think about it, the other interesting reason to me is that I have a PhD in robotics. In my mind, anybody, you can only have one car, but you can always own multiple robots in the future. So that's why there is much more imagination in this industry.
Yeah, really speaking to the massive demand potential.
Sure.
Could you talk us through as well the Toyota partnership? How do you see that helping to build up the business even further?
Yeah, we're very glad to see alongside one of the already we announced the top European program, we're actually already for that European OEM, we already achieved the C sample, which is the most important phase before you go into production. So everything's ready lined up for production. But other than that, we already have multiple JV programs with global OEMs across the world, including Audi and Cadillac. They're entering production of their JV vehicles in China. We have that. And then recently, we're very glad that we opened a new door with Toyota JV in China. And now we work with American, European, Japanese OEMs in JV altogether now.
David, final question for you. We've learned that your company could list in Hong Kong this year. Are you looking to list your shares in Hong Kong this year? Is a question.
Well, I think there is always a chance to list additionally to the NASDAQ. We continue to evaluate that. And also, Hong Kong has great food, let's be fair.
Okay, so we guaranteed, the meal's on you. I'll pay for my share. And then we expect you here in the studio if and when, of course, you list. Okay, David, thank you so much for the time. And yeah,
thank you
great
for
set of earnings.
Me.
And
thank
yeah,
you.
good and congratulations there on the Toyota agreement there. Okay, David Lee, co-founder, CEO of Hesai Technology. One stock that is, and one company that has gone listed here in Hong Kong. Wow, check that out. 300% on Guangzhou. Innogen Pharma. And, by the way, the CEO joins us this time in the next hour on what they plan to do with all this money that they raised. Plenty more ahead. This is Bloomberg.
Let's take a look at some of the movers in the pre-market session. Looks like it's going to be a down day extension of yesterday's losses. But, of course, we have a couple of stocks that we're keeping an eye out on as well, David.
Yeah, JD.com, JD Health, that's an earnings story, as with CK Hutch. Weibo was also out before the U.S. markets opened up. So massive move up in Weibo overnight. We're mirroring that going into the open today. Not much movement as far as CK Hutch is concerned. I mean, the big number was that 92% drop in net income. That was a one-off merger-related non-cash, so the market's perhaps looking past that at this point in time. Right, the other big story we're tracking is this listing here in Hong Kong. Guangzhou Innogen Pharma has massively oversubscribed in a sector that is massively outperforming. We're talking biotech here, and it's unsurprising why the stock is trading higher by 300% in the pre-markets. The opening bell is coming up next. This is Bloomberg. Good morning, happy Friday. Welcome to the China Show. Counting down to the open of trade. We'll get the opening bell. Futures are pointing down. We'll also be getting the new home price numbers coming through as well. An update there. So 25 straight months of declines. Do we get month 26? And of course, 30 minutes from now, we'll be getting the activity numbers coming through. Stay tuned for that. On the left side of your screens is this listing coming through in the city. Biotech firm. We're looking at Guangzhou Innogen, their pharma. The stock is up 280% in the pre-market. Massively oversubscribed. It's one of its products, of course, is treats diabetes, and I believe, of course, they are looking to test that for obesity. So we'll see, of course, how that trades, and the CEO, Avril, of course, will be joining us later on the show. Avril.
Yeah, you were mentioning earlier many times oversubscribed in the retail tranche. There you go, the gong at the open of trading on Innogen Pharma. Well, let's take a look at what we're seeing on the mainland as well. I mean, today is a day where we're waiting out for the retail numbers, the industrial production numbers out of the mainland. And against that backdrop, it's also the home price data that is due, I think, any time now. Aside from that, we had US PPI really raising doubts about the extent in which the Fed can cut, right? Even though we are still mostly pricing in fully that 25 basis point, the Chinese markets are taking a bit of a breather again, down for another session at the start of trade. You're seeing the likes of Guizhou, CATL. Those are the stocks that are a bit of a drag today. So tepid in terms of sentiment. Bonds are catching a bit. Take a look at the Hang Seng markets at the start of trade. Of course, a lot of this is the earnings digestion. We had JD's revenues beating. Profits were a miss. JD Health, by the way, was upgraded to buy by HSBC. And aside from that, CK Hutchison, that's the other one we're watching, down in the session for the moment after profits plunged. This was because of a one-time charge in relation to one of its mergers, but we will unpack that a bit more in just a bit. Take a look, though, at how JD is faring after it reported that numbers. So down 3% at the moment, just to highlight the extent of the decline for you. David, you have some data for us.
Yeah, I do. So we have new home price numbers coming through. So this is for the month of July. So existing homes are down 0.5%. We are also getting new home prices coming through as well. We are down on that specifically about 0.3%. So the drop on new home prices is actually faster than the previous month. As far as used home prices, the drop is slower than the previous data point. All things equal, both still showing declines year on year, month on month rather, negative 0.3%, negative 0.5%. Although, of course, it has been falling for 2 years now. So, yeah, you could make that jump from month on month statistically to year on year, still falling there as well. Okay, so we talked about this. Lots of earnings coming through. I mean, just before we talk about JD.com, Avril, just to mention as well. So it looks like Meituan is also falling. Quite a big decliner right now, 3% down. Baba's down 3%. Lenovo, which was down yesterday, earnings story, also down still 3.6%. And MTR, which also reported earnings earlier on, and the CEO joins us in a couple of minutes, is the biggest decliner right now in the Hang Seng Index. We're down 5% on shares of MTR. So it's a big, big earnings day to get through, I would imagine now, Avril.
Yeah, I mean, for JD, right, it reported second quarter revenue growing at a faster than anticipated 22%. And it also benefited from these consumer subsidies, aggressive but costly drive into new markets, such as meal delivery. And so profits halved. And our Bloomberg Intelligence senior analyst, Catherine Lim, joins us now to break things down. So, Catherine, what do the results tell us about the intensity of competition in the sector?
Well, Avril, basically JD.com's retail profits were all eroded by its investments into food and on-demand delivery. And this literally sets the tone for what we can be expecting from Alibaba and Meituan as they report over the next 2 weeks itself, that the intensity of the competition into food and on-demand delivery was so intense in the second quarter. I guess overnight, really, as we took out from what the company is guiding, I guess that was really very little to assure you that, you know, things are over, you know, they're going to focus on profits again. I do think that the pressure is going to continue through the end of the year. So we'll have to actually see what comes through for Alibaba and Meituan as they guide.
What is your sense, though, just unpacking JD a bit further, how sustainable this is given, you know, maybe they're not going to come through with so much ongoing discounts? What is the extent of growth that's expected?
Yeah, I guess, you know, they've highlighted that they had an impressive 40% year-on-year growth in quarterly active customers, which is all great. But we all know that there was that huge promotions and perks that actually literally drove that. And, you know, once you take that off, the big question remains, how sustainable will that be, particularly the kind of momentum that we are seeing? And I do think that that's what market is really watching out for, that, you know, if you scale back on these subsidies itself, how loyal will customers be, you know, to your platform, to ordering more?
Right, Catherine, that's a good question. I mean, certainly, anecdotally, yesterday I was having food delivered, and I saw, okay, the minimum was quite high. You know what? I didn't eat, right? So I guess that's an indication, of course, of what happens to demand if and when, of course, you cross that threshold, the elasticity of demand, as they call it. All right, Catherine Lim in Singapore for us. From one earnings story to another, CK Hutch, related assets or related stocks, I should also mention. CK Asset is down 2%. Hutch is up about 0.5%. You have an over 90% drop in net income for the first year. The details, of course, coming through right now with Shirley Zhao, our conglomerates reporter, here with us to help us understand what was behind that substantial drop in profits.
Right, so CK Hutchison's profit dropped 92% because of a one-time non-cash loss arising from the merger of its UK telecoms unit and Vodafone. The merger happened in May, and it actually generated £1.3 billion in cash for CK Hutchison, but it also incurred a non-cash disposal loss as well as transactional expenses. If you look at the operations side, CK Hutchison's operation were actually doing pretty well in the first half. Its operational underlying profit rose 11% in the first half of the year, mainly because of its ports business did quite well and its retail did quite well, and its other main businesses, including telecoms and infrastructure, were pretty much resilient.
Oh, well, you mentioned the ports deal. Did that come up?
The management in an earnings call told analysts that they expect there is a good chance that there could be a deal with the participation of a major strategic Chinese investor in the buying consortium. And Bloomberg reported earlier that China's state-owned COSCO shipping company was in talks with the buying consortium to join the buyers, and they are negotiating for a very powerful role and a significant role in the consortium. But the management also don't expect that the deal could be completed or a transaction could happen this year because of the scale and the complexity of the deal. So remember, this deal involves 43 ports across the world, so there would be a lot of different authorities in different countries that they should get approvals from.
Right, that could drag on for a while yet. Shirley, thank you so much. Bloomberg, Shirley Zhao. Some other earnings that we're tracking across the region. Hesai says it expects sales of servers to more than double this quarter while its consumer electronics business dwindles. The company predicts a 170% rise in revenue from servers made for artificial intelligence tasks. Hesai has been navigating geopolitical shifts while it tries to diversify its manufacturing footprint and tap the AI boom to offset volatile iPhone sales. Weibo's second quarter adjusted EPS rose to 54 cents, beating analyst estimates. Ad revenue gained 2.2% to $383 million, lifting total sales to $445 million. Monthly and daily active users also topped forecasts. And shares in Hong Kong subway operator MTR in focus, reporting first half net income climbing almost 30% to 7.7 billion Hong Kong dollars, with underlying profit up 55%. And the company says the city's retail sector has yet to fully recover from the effects of the pandemic. It also says it's continuing to see growth opportunities in mainland China and overseas. David.
Yeah, in fact, in just a moment, we'll talk about all those things, mainland markets, opportunities there, overseas markets separately, and of course, the local markets, and also the weather disturbance we've had here in the city. So Jacob Kam joins us, of course, the MTR CEO, in a couple of minutes to talk us through their earnings report. Plenty more ahead. This is Bloomberg. Right, welcome back. You're watching the China Show. We're in the thick of earnings season. MTR, of course, Hong Kong-listed railway operator. We're down about 3%. Quite a drop, of course, in shares today. The company, of course, net income jumped there. Revenue, though, down about 7%. But the company's warning that Hong Kong's retail sector has yet to actually fully recover from the pandemic, and it will continue to seek opportunities, growth opportunities outside Hong Kong. Joining us now is the CEO, MTR CEO Jacob Kam, here with us on Suset to take us through the numbers and the future. And we'll talk about the future in a moment, Jacob. Very nice to see you. I was hoping to start off not on the reported quarter, but all this really bad weather we've had in Hong Kong let's call it month and a half. I think 5 black rainstorm warnings.
And typhoons before that?
Typhoons before that. Yeah. I think, yeah, the T10. You forgot about that.
That's right.
What's the impact you've seen in terms of foot passenger traffic?
Well, MTR turns out to be the most reliable transport in town. But of course, bad weather will impact people do not have to go to work, and therefore they will have an impact on patronage. But at the same time, we also see an increased footfall in our shopping malls. What we have done is to get more prepared for significant weather impact. But because most of our systems are covered, so we can maintain frequencies, maintain journey times without significant difficulties. And also because of our rail press property development, we have integrated the property on top of railway stations. Therefore, passengers could go out without a brolly, even in black rainstorm, from home to work and back.
Yeah, we were joking before the break that people who are pretending to work from home are actually or perhaps gallivanting.
It's just their family who are wandering in the.
Oh, okay, well, they're working, of course.
They are working, of course.
How was the last quarter? The report. What went well? What didn't go well?
We have seen half-year profit up because we are mainly contributed by the property development profit. We are in a harvesting stage of our property development program. Our recurrent profit has gone down. Mainly, we believe, is because of the new normal in traveling pattern as well as consumption retail patterns. We have actually increased costs in investing into technology to improve our future cost base, as well as creating a better customer experience in the new normal.
Yeah, maybe the stock down today is perhaps an indication there is some slight concern that if recurring revenue keeps falling, what's the company's plan to structurally maybe address that issue?
Well, our fair revenue income has actually gone up.
Okay.
Primarily because of the cross-boundary patronage has increased, both normal cross-boundary as well as the high-speed rail service. There is pressure on our rental income for both the station commercial as well as the shopping malls. But as I said, as we are adapting to the new normal, we are hoping to ride on, for example, the mega events, the IP events, major sports events, and hopefully they'll create new revenue streams for us as people go out and enjoy the events.
Right. I've actually anecdotally noticed there's a lot more visitor foot traffic in the city. Can you distinguish in terms of your data which are the sort of the more frequent users of your network and which ones are sort of visitors? And have you seen that latter portion increase, in fact?
A lot of the visitors from the mainland, they are already using autobus cards like our locals, so it's actually in a way difficult.
Okay.
But there are also, of course, visitors who buy our visitors special pass.
Yep.
And of course, we do notice a gradual increase in both our Airport Express service as well as our cross-boundary service of new visitors.
Yeah, I think that's East Rail Line, for example, which takes us to the two border. Can you talk a little bit more about that? How much, almost on a year-on-year basis, how much increase have you seen across that? That line that takes people all the way through and back, of course, from the border.
That's right. Well, we have two land crossing, Lowu Station as well as Lomachau Station, served by the East Rail Line.
Yeah.
We have seen in the beginning of the year, we only see a small increase, and gradually that increase is building up. We're hoping that the momentum will continue, so that increase will actually go even further for the rest of the year. So that reflects not only Hong Kong people going up and then coming back, but also an increased number of mainland visitors coming to major events in Hong Kong.
You mentioned earlier on you're in the harvesting stage for the other big part of the business, of course, which is property. There's a notion that you're too dependent on property, and that's probably going to show up even further because you mentioned it's a harvesting stage. How would you address those concerns?
Well, now railway creates a lot of value, economic value, to the city and to the communities.
Right.
However, itself is a challenging investment. Railway. The essence of rail press property model that we have been using for the last 45 years.
Rail press property.
Rail press property is to using property to capture some of this external value that the railway creates and put it back into supporting the railway's construction, operations maintenance, as well as asset renewal. So this is how the whole model is working. So we need to look at the business as an integrated whole, although the railway is the core business. But the property is the external value that we capture to support the railway.
Almost a financing model, if you think about it that way.
That's right.
Talk to us about overseas. How are you looking at that?
We continue to look for opportunities outside of Hong Kong, both in mainland China as well as elsewhere. But of course, we will only enter into opportunities that will that our strength will actually create an advantage, competitive advantage, as well as, of course, bringing a reasonable return to our shareholders. Now, in the mainland of China, in addition to the railway business, we are also very strong in terms of station commercial experience. We have extensive experience in Hong Kong, and we are helping the mainland metros to basically to create and grow their station commercial business.
Now, MTR is perceived by some as a Chinese company. Now, whether you agree with that or not, and whether or not there's an accurate description, of course, of it, the reason I bring that up is, do you think politics has become a challenge for you to bag overseas business? I'm wondering whether or not it is actually something to consider and how you're planning to get around that.
Well, we have a growing business in Australia, for example.
Right.
And we're also exploring new opportunities in the Middle East and the ASEAN countries, mainly countries along the Belt and Road.
Okay.
So it is, I believe we are making headway into those places.
Okay. It's a reality of the business environment. So wait, a few more questions for you. Last few months in the job.
That's correct.
Anything else you wish to see before you set off?
Well, for the next few months, I have to concentrate on my current duties.
Right.
We have major construction work going forward, as well as investment in technologies, as well as growing our patronage and so on. So there are plenty of work for me to focus on. And of course, I'll make sure that it will be a smooth transition at the end of the year.
Okay. And Jenny's ready, you think?
Definitely, most definitely. Jenny is actually very experienced in multiple businesses within the corporation. She has also been here for a reasonable time. She understands fully the strategic direction of the business development, of the company's development, as well as Hong Kong's strategic positioning. So she will do a good job with a very strong team that we have built up.
And apart from doing media interviews, what is the one thing you're going to miss the most here about your job?
I will miss the time with Bloomberg, definitely.
Oh, come on. Okay, well, thank you for that. Does a former CEO of MTR get free rides for life? Like, how does that work?
Yes, we do.
Okay.
We have to work for a number of years before we get that, yes.
Yes, well, that's well-deserved. Jacob, thank you so much for taking the time to speak with us. Jacob Kam there, CEO of MTR. And by the way, you can get an insider's guide to the money and people shaking up the finance hub here in Hong Kong. Our Hong Kong edition newsletter out every Thursday. You can sign up via the Bloomberg.com/newsletters. Plenty more ahead here on The China Show.
Ooh, we are counting down to that China activity data for the month of July, but in the meantime, continuing to watch how things are playing out in the session amid these earnings from Chinese companies. JD, for one, revenue beating, profits were a miss. As Catherine was talking about earlier, it's really that competition. Does this highlight what's to come for the likes of Alibaba, Meituan? JD Health really seeing a pop there. Not only did it beat on revenues, it was also on the receiving end of an upgrade by HSBC to buy. CK Hutchison, another one in the green. We talked about that earlier, that profit miss. This is a one-time charge. And Weibo, 10% almost. That's the climb after quarterly earnings beat estimates. And aside from that, keeping tabs on stocks that have just begun trading in Hong Kong. Take a look at Innogen Pharma. After it was really well received in the retail tranche, we're seeing that pop 200% plus earlier, pairing some of the earlier gains though, but still really, really solid showing at the start of the first day of trade. Property stocks also in focus. We talked earlier about how there seems to be a sort of backstop for the sector. Now these SOEs might be brought in to buy up unsold homes after previous initiatives which involve the local government were not as successful, limited success. success. That's one way to characterize it. We also had China home price data still looking pretty concerning. But of course, the data count down to 10 a.m. Local time, David.
Yeah, just under 7 minutes away from that. In fact, we're going on 6 minutes. And just to mention, too, so 4.6%, I'm going to read the median here, not the range. So if you're an economist listening, you don't hear your forecast, don't get upset. This is the median, unless you have a median forecast, of course. Median is 4.6% on retail sales year on year. Year to date is 4.9%. You do the math on the median, on the monthly, then you get the year to date extrapolation. Factory output year on year, 6%. Also a drop from the prior read of 6.8%, and we're also looking at a 2.7% fixed asset investment, also a decline there from the previous month. Property investment year to date, negative 11.5%, negative 11.4%. That goes into the property story that we just showed you earlier on, and a tick up at 5.1% in the survey jobless rate is also coming through as well. So the actual numbers are coming through in a couple of minutes here. We have a lot more on the way here. Keep it here. You're watching The China Show. Good morning.
Welcome back. You're watching The China Show, and here's a look at the offshore yuan as we count down to that release of China's activity data for the month of July. As you see there, that live shot from Beijing, waiting to hear those numbers and what the State Council has to say about it. Of course, this could potentially inform the kind of stimulus bets that we're going, and also how the supply side reforms and bad weather have kind of been in the mix when it comes to China's industrial output. Also watching for signs of the extent in which retail sales, of course, the slowing, that is what is expected. Dollar China for the moment at the 718 handle. Of course, we saw the climb in the greenback amid all this. David, you have the numbers.
Yeah, they're out. Okay, and not very good ones. Let's start with retail sales here. 3.7% is the actual year-on-year number for retail sales for July. The median estimate was for 4.6, and I believe, just looking at the range of forecasts there, yes, that did come in. Retail sales actually coming in below even the lowest forecast. So this one really missing the mark. We're looking at industrial production year-on-year. This is July, so a monthly number, but year-on-year, 5.7% on the year, also missing the target of 6%, and also clearly a slowdown from the previous month. Fixed asset investments are out as well, 1.6%. Also missing, this is a year-to-date, year-on-year number, also missing the mark by more than a full percentage point on growth. Property investments down 12%, and retail property sales year-to-date, negative 6.2%. So the jobless rate has also picked up above the estimates of 5.1. So the jobless rate for July also coming in worse than expected, 5.2%. So I'm looking across all the numbers coming through here, and it does seem this is an across-the-board miss on monthly activity numbers, which is, I guess, in one way consistent with the PMIs and the business surveys coming through, plus you have to throw in the weather. Now, I think the question now is, does this mean that policy will be less reactive and measured into being able to address this current bout and this current slowdown? Let's get initial reaction and perhaps what this means for policy prescription. And joining us here on set is Chang, Chief China Economist at Barclays Asia Pacific. Good morning and nice to see you.
Morning, David.
We just talked about the numbers. I'm not sure how much you were able to hear there, but just your initial glance at across the board miss.
Yeah, I think we have to recognize Q2 was actually a very strong quarter. Right, the June, I remember retail sales jumped, and the average May to June retail sales was 5.6%. So some payback and some moderation should be expected, but obviously we wanted to dig deeper into.
Right.
For example, we knew that the trade-in subsidies were reduced, or many local governments were running out of money, so that had led to actually some recovery in home appliances prices, as seen in the CPI data, but also, we were expecting that would lead to a slowdown in retail sales because some households would wait.
Right.
The third batch of the trade-in subsidy actually came in, we think, around late July. Yeah.
And I think the most recent development.
So August data should see some recovery. That's what yeah.
Okay. So looking forward, that might see a bounce if the consumers that were waiting, that had put it off, will start purchasing in August. Well, that takes us into the subsidies question because there's subsidies on appliances and very recently subsidies to consumer and personal loans. What benefits initially do you think will come of the subsidies to personal loans specifically?
I think overall we've seen that the government have been focusing or continue to focus on their prioritization for this year, which is boosting domestic demand / consumer demand / I think in particular services consumption. Right? We've seen this personal consumer loan interest rate subsidy. Mostly offered by 1 percentage point.
Yeah.
And there was also some subsidies. There was also subsidies for services companies.
Yes.
Right, in the catering, and some of those I think hard hit industries in this current environment. So I would like to view these as part of the efforts from the government in boosting consumption and the domestic demand, alongside with those subsidies to preschool education and to childcare subsidy, to disabled elderly cap subsidy, right? So we've seen a flurry of these. Individually, they may, have a 2 percentage point contribution.
They add up, though.
Yeah, but they add up to, by our wording was incremental policy support is going to put a floor to growth. So we were looking for 2 months ago a moderation in activity, but unlike others, very bearish, we don't look for a collapse. We were putting retail sales growth in the second half of the year to somewhat around 4.5 to 5%. Obviously, there's a big gap from the July data, but we do see, the government is going to step up efforts to support consumption.
Chang, Avril in Singapore here. The government measures to help boost consumption. How helpful is that going to be with the property sector in the state that it's in? I mean, we're seeing property investment deepening contraction. Is that just slapping a Band-Aid on the problem?
You are right in that the reason why we've maintained a below consensus forecast for China growth was because of the property sector, that we had been more bearish than streets on the property sector and more bullish on the export side, turned into more constructive on consumption since Q1. So on the property, our forecast was actually a minus 12% contraction of in further contraction in the property investment. And if we look at all the leading indicators in property in July, and that all points to across-the-board deterioration. And indeed, I think that would remain a big drag to economic growth, as well as exerting continued downward pressures to prices and to kind of the disinflation expectations, as well as to, I think, also a labor market that have seen continued deterioration across the board.
And are you expecting Are you expecting, amid this deterioration, some form of property sector support? I mean, we're hearing that potentially they could tap on SOEs to buy up unsold homes. How effective do you think a measure like this would be?
Last September, October, around the policy pivot, I was also advocating on, the policies or like property stabilization fund of trillions or central government-led kind of a restructuring, etc. But I think judging by the Politburo meeting in July or, the government work report in March, the priority for this year, I think, would continue to be on consumption and the tech sector, right? So we would see more fiscal subsidy partly coming from the already budgeted spending. But in terms of the new property measures, there could be some. We saw like SOEs buying inventories, or the government buying inventories to distribute or rent it out. We continue to see such news. It may happen in certain local government who has the fiscal capacity. But I think broadly speaking, it will be kind of still a slow burning for the property sector.
You alluded to some of this, right? That exports slow down. What are you expecting in terms of the evolution of the U.S.-China trade relationship? Are you still expecting potentially a lower effective tariff rate in the midst of all this?
Actually, I think the consensus view from clients from the streets since late June, as also highlighted by our Barclays global research, is that the trade truce likely to hold. The 30% new tariff likely to be stay and extended in the rest of the year, with some room for the fentanyl tariff to be reduced. But that's all up for obviously negotiation. So for now, I think this. For the moment, given the rare earths is meaningful leverage, so the re-escalation is less likely. But I think there's remain a lot of uncertainties in terms of on the tech sector, on the maybe even financial sector. We see both governments actually are taking more actions. And our Chinese government are also making more preparations.
Yeah, hopefully we are headed in that direction of certainly no longer restrictive levels of tariffs, and hopefully they come together and finalize, and we can put this behind us, right? But the reason I also bring that up is it's interesting when you look at the July set of numbers, right? So it's now complete. We have activity numbers and we have exports. Activity doesn't seem okay. Exports, though, beating by a wide margin. And I wonder what your expectations are for exports. Does that part of the economy hold up in the second half, if not actually even improve?
Yeah, I think indeed this weak domestic demand versus continued kind of outperformance in exports have been going on for pretty much the past year, right? Just to a slightly different extent, and also like physical markets respond to some of the government stimulus measures. Then we have some bit of volatilities in the monthly data. But the big trend have largely stayed the same. In fact, last June we published a piece highlighting 3 cyclical factors and 3 structural factors, to underpinning a kind of a constructive or bullish view on Chinese exports. We had with the title "Enduring Bright Spot," which I think have largely played out. So we would continue the 3 cyclical factors, including DM, consumer demand, the U.S. consumers, to some extent the EU, European. And the second would be the global tech cycle, and also the AI boom, which to some extent have extended from last year to this year. And the third would be the real effective exchange rate, which dropped by another 6%. Okay. While last year we were reporting around 15% down from the peak. Right? So these are all adding to competitiveness and the stronger external demand for Chinese exports. And then the structural factors, obviously, including, I think what people are talking widely now, diversify the global markets, which every other country are also looking for, and also this leading technology in many of Chinese companies. We have not only electrification, but also digitalization and also autonomous products that is with much better value for money, alongside with Chinese companies going global. So I think these factors have certainly played a big role in contributing to this continued, exports beating expectation. So we remain slightly more positive than the streets on Chinese exports in the second half of the year, but I think some payback would be unavoidable. So we were tracking, say, things like overall cargo throughputs, and that have saw a big decline, and which has been tracking the overall export movement quite well. And then this container shipping data, which tended to track the U.S. exports to the U.S. reasonably well.
I was actually going to ask you about that because tell me if it's tell me if I'm remembering it accurately and if it's statistically relevant for an economist's perspective. I think the value of non-U.S. exports from China went up from 85% to 89%. So it's a 4 percentage point drop in other words, this sort of weaning itself off that export market. Is that significant, and is that indicative of a trend? Chinese exporters looking for other markets.
I think the trend have already started since 2018, when President Trump first announced the tariff on China. So part of that shifts reflect, say, trade rerouting or transshipments. But part of that reflects the expanding export markets. For example, Singapore, or Australia. These are not the countries necessarily wants to be a big manufacturing hub for EV. So they would import a lot of Chinese EV. Or in Latin America, like Brazil or, Peru, and there's also Chinese companies, EV companies building the production lines. And so certainly alongside with that, we would see more exports. So there's a variety of reasons other than transshipment. That are I think would put a certain floor for Chinese exports. We won't see a big collapse for the overall exports.
Okay, Chang will be staying with us here. She's with Barclays. Lots more to talk about. Inflation, anti-involution as well. Right, we will leave you at live pictures of the National Bureau of Statistics press briefing taking place at the Capitol. As we speak, we'll take a very short break as we digest the activity numbers, which miss across the board. But when I look at markets, largely, not completely, largely brushing off the weak numbers. Tia Livigo gives you the context there for analysis and the latest numbers as well coming through. Plenty more ahead here on The China Show. Right, welcome back. We're about 47 minutes and 17 seconds into the cash market session. Benchmarks are down about 1%. We're coming off lows of the day. Shanghai Comp, though, is still moving up 0.3 of 1%. And again, we are flirting with 10-year highs on the Shanghai Composite. We're just coming through the data as well. We'll get you more on that in a moment. But a lot of big movers across these markets, individual movers, earnings, and really indicative, Min, of this, or painting a picture of micro over the macro. What can you tell us, Min?
Yeah, we're looking at all the earnings reports that are coming through, right? And here we are looking at some of the biggest losers on the Hang Seng Index today. This three-way fight among the food delivery platform. JD.com, of course, reported earnings yesterday. It was a beat on the revenue front, up by 22% versus estimates of 6%. But the profits were pretty much wiped out, down by 78% because of the intense price competition in the food delivery sector. We're talking about almost free milk tea and all the investment going into these promotions, leading to analysts really revising down the forecast across the sector. So we're seeing JD.com, Alibaba, Meituan all pointing down today. Now flip the board, take a look at some of the other earnings that has come through so far. We have about a fifth of the company on the Hang Seng already reported and about 70% surprising to the upside. So here you can see, whoa, JD.com up by 15%. This is the highest that we have seen since 2023. After an earnings beat, we have Macquarie raising it to outperform, HSBC raising it to buy. The price targets largely revised by double digits for JD Health. Of course, it's also benefiting from that consumer loan subsidy that is helping lift the healthcare sector overall. Weibo as well, beating estimates on earnings, 8% up, and CK Hutchison looking pretty resilient here, up by 2% despite that one-off hit to the profits by 90% because of this merger of its UK telecommunications unit with Vodafone, although its other core business, the retail and port business, is still showing pretty resilient profits, up by about 11%.
Min, thank you so much. Min Low, our China correspondent there. I just want to zero in on JD.com, of course, and the sort of market reaction you're seeing on the back of JD.com is really Meituan also falling as well, right? This sort of fierce competition, first to the bottom is the question, and certainly anti-involution, which disincentivizes that race to the bottom. What does it mean from a macro perspective? Chang is still with us here on set. Chief China economist at Barclays, Asia Pacific. And yeah, I haven't got your thoughts on that. So there's a policy push to incentivize private sector to stop cutting prices. But at the same time, you're getting subsidies and everything else that if you think about it, is deflationary in nature. Do those things contradict each other? Like, how are you approaching this exercise to reflate prices?
Yeah, well, I think if we took a look at the timeline of the anti-involution movement, let's say, the central government first highlighted it July last year at the Politburo meeting. And fast forward March this year, we were highlighting in the report, the government, Premier Li highlighted in the government work report to comprehensive rectification of the evolution, right? Yeah. So clearly, on the back of this, excessive competition and also, driving really corporate profitability to negative, and with intensifying price war, and especially as seen in the EV sector, but also we saw this food delivery and companies. So I think that really have raised a concern for the government. Not only I think it is deflationary, and which was why we were tracking since the beginning of last year when Tesla started the price war. But also it was hurting, squeezing the profitabilities along the supply chain. Right. And also these big players tended to really delay the payments to their suppliers, which really led to a very negative kind of spiral. Yeah. And in the whole economic system. And that also, I think, to some extent, on the margin, adding to this worsening of deflationary expectation. Right? So I think it's encouraging to see the government is taking action on that. On the back of reasonably strong, let's say, GDP growth in the first half of the year, because there would be a trade-off, right, between price and the sales or production. Because part of the government efforts is to curb the production, curb the excess capacity, and also higher price, as we've already seen, like auto price ended a 5 months decline and stabilized for the first time on a month-on-month basis in July. We see in the CPI data released last week. So that actually happened, the same time we saw some of the EV makers, BYD or XPeng, has been posting falling sales, right? So because they were, had to keep the price, stable. So I think in a way there is a trade-off between price and sales. And
final question for you: this time next year, where do you think inflation is going to be?
I would think that up higher than. So this year we look for 0.2% CPI inflation. I think after 6 months of government's effort on the margin, that could add 0.1, 0.2 percentage point to CPI inflation, and we would also see PPI deflation narrowing on a sequential basis. Okay. But obviously, I think the government needs to do more on the fiscal side, on the spending side. Central government needs to further add leverage, as we saw from the credit data, right? Private credit overall contracted for
bond
the
purchases,
first time.
Issues.
Yeah. So, but the government should add more leverage next year. Yeah.
It is a policy priority. So all things point to that direction. Thank you so much for taking the time to come here. Jian Chang, their Chief China Economist at Barclays Asia Pacific. You're looking at live pictures from the National Bureau of Statistics press briefing. I should mention one specific note here because of the uptick that we've noticed in the employment rate to 5.2%. The NBS is saying that it's down to, because it is graduation season. There we go. Subscribers can check this out. TA Live Go on your Bloomberg terminals. Plenty more ahead. This is The China Show. Right, welcome back. Oh, it's busy on the news flow. So away from the monthly activity numbers which came through, I think on the property side of things, as you can see, a rally is taking place on the benchmark and some of the big names. That's despite, of course, the slowing even further of property prices. Might be down to a reporting, of course, of perhaps new measures being mulled to address the inventory issue. Very quickly, about an hour into the cash market session, big listing today, up 280-90% at one point. So it's rare to say we're coming off highs of the day to 170%. The CEO joins us in a couple of minutes. This is Bloomberg. Right, we're going into the Tokyo lunch break. Just a brief look. We had some GDP numbers which came through. There we go, 1%, blowing through estimates. What it means is, again, the deflator conversation's going away. You have a gap for higher rates. And some monetary space to do so. We're getting the banks actually reacting quite nicely. As you can see, the 10-year yield's up, and as you can see, there we go, we're up to 4%, at least in AMCC on your screens, on the back of, again, that point we were just making of expectations for a rate hike are certainly bolstered by, well, funnily enough, backward-looking numbers. But anyway, there we go. We'll take you straight back right now from Tokyo now to Beijing, where the National Bureau of Statistics is still conducting its live briefing following the release of some numbers. And I think one of the things that's come through in the last few minutes is this line on the acknowledgement that there needs to be more internal drivers for consumption for that portion to be strengthened. Number two, they also commented and gave important context on why we did see a tick up in the unemployment rates. The labor market participation, I believe, is what they're alluding to there with its graduation season. So there is, of course, a cohort of fresh graduates hitting the job market. I should also mention, when you look at the market reaction, seems to have catalyzed a move on dollar China and also equity markets. So Hang Seng Index now down 1.3%. Session lows or near session lows in the last few minutes or so. Hang Seng China Index also down around that same level. Dollar China seeing some weakness coming through. We're now looking at session highs on dollar CNH. We're now trading at about 718.56. As far as that is concerned, yes, we're just at highs of the day. So trying to figure this out. It might be down to the data, it might be down to something else. But as you can see there, so markets are reacting at least more visibly to what's going on, if that is, of course, a catalyst. I should caveat that just to avoid speculation. Okay, we will table that for now. We'll get you more details, more important material details coming through once we have more information from the NBS. In the meantime, more on the fiscal side of the conversation, this time in New Zealand, where we have the finance minister talking. She says she understands why the U.S. has set tariffs at certain levels for countries which have trade surpluses with them, including, of course, New Zealand. But she also told us it's difficult to see such a small country as a threat to American industry.
We have very strong and long-standing people-to-people ties. Our two countries have got along well for many, many decades, and we think it is in the interests of both countries that New Zealand continue to be a strong relationship that the United States can look to and rely on.
So is this White House, though, impacting the relationship, the strong relationship that New Zealand has had with the United States in any way?
We continue to view the United States as our friends. Now, of course, we would prefer not to be facing additional tariffs. Find me a country that says, yeah, we really like additional tariffs. And we're not in that. We're not in that situation. And we have a history of pursuing freer trading agreements. We have very, very low trade barriers for United States imports, and we feel we've treated American exporters very well. So we would prefer to be on a lower tariff rate. We've ended up at 15% as a base rate, which reflects the fact we have a small trade surplus with the United States. We're talking very marginal New Zealand dollars, 500 million. So it isn't big. We don't really think...
But it's disappointing that it wasn't maybe the 10% that folks were thinking initially.
We would have preferred that. We understand the rule that's been applied, but it's hard to conceive that New Zealand, a country of 5 million people, is any kind of threat to the manufacturing or industrial base of America.
Does it lead, though, and I guess we're trying to figure out, we talk a lot about the geopolitical world order changing around. We talked about, the president was just asked about maybe closer ties between China and Latin America. China already has a presence, we know, in Latin America, but maybe they are increased as a result of what's going on. Are you forging different relationships because of some of the strained relationships out of the United States, or strained relations out of the U.S.?
I wouldn't characterize it that way. New Zealand has always looked to forge relationships around the world and to reinforce the rules-based system wherever we can, and to work through multilateral institutions because we're small and our voice will never be the loudest. Like the United States, we have a strong and important economic relationship with China that we've been able to maintain while also taking very different points of view on many matters, and we've been able to balance those two things.
So not strengthening them with China because of maybe what's going on?
No,
today?
I would not characterize it that way, but continuing to lean into our relationships where we have common interests. So we are members, for example, of the CPTPP trade relationship, and we have welcomed the EU's interest in becoming a dialogue partner and looking to reinforce that trade arrangement. We've recently signed free trade agreements with the United Kingdom, with the European Union. They're important, with the GCC, the UAE, and we're pursuing a trade relationship with India. We think it's very important as a small exporting country that we have options in who we trade with, and wherever possible try and open more doors. We've got a grand history of doing that. We were one of the first countries in the world to drop subsidies to ensure that we were genuinely open to the world. We won't get rich selling to ourselves. We're too small for that. So we do well when the world welcomes our goods and services.
Really, really good convo there with Carol Massar, of course, our colleague in New York, with the Finance Minister of New Zealand, Nicola Willis, there. And for our Bloomberg subscribers, you can watch us live or maybe catch that one. Some of the other ones you might have missed. We had one earlier on here on the show with Hesai and also with MTR. Think of earnings season, suffice to say, TV Go is the function you run to be able to scroll back to any of those things that you might have missed, and also check out the functions that we've run here on the shows. Check it out, TV Go. Right, welcome back. You're watching the China Show. Happy Friday, by the way, if you're just joining us right now. To the left are scenes from the stock exchange just over an hour back, of course. The man you see on the left side of your screens, Wang, of course, founder, chairman and CEO of the company that went public here today in Hong Kong. It's rare for me to say this. The stock is coming off highs of the day and is not only trading at only 180% up from the IPO price. So it's a biotech firm, and of course, it does help that massively oversubscribed, especially the retail tranche of this listing. It also helps that the sector has done massively well. There's a lot of bullishness around all the developments around the Chinese biotech space, and certainly it's a good time to be listing, suffice to say, here in Hong Kong. Joining us now on set from the stock exchange, they made their way here very quickly, is exclusively, by the way, is the founder, chairman, and CEO, Wang, out of the company here today. Good morning, and nice to see you.
Good morning. Very nice to see you.
Just looking at, I just want to start with the stock price. It's done very, very well. Should you have raised more money in the market? Was that even a consideration, looking at how high the demand was for your listing?
I think this is a very good sign. For instance, the IPO, it's a very important milestone for the company. So we have been doing a very important research because, our goal, the aim is to translating those very basic fundamental science to the clinical side.
Yeah.
So, this is a long procedure, right? That will be very much cost. So I think raising fund is a very much important step for the company, particularly in the current stage. Our product has been approved by access to the market by Chinese FDA, and also the core product of our company is called F-superglutide alpha.
Yes.
So now we're at the stage of commercialization. Also for the marketing fund, that's very much important for to translating or facilitating our efforts to further develop our product.
Mm-hmm. It's, as you point out, it's been approved for diabetes. I think the current process now is you want it also approved for obesity.
Yeah, obesity, overweight, and also metabolic dysfunction associated fatty liver, for instance, and some other metabolic chronic disease. Yeah.
What's the update on the approval process? Do you have a better understanding of when you might get the green light for that? I know that's a long process, of course.
Yeah, it's a long process, but we have made very significant progress on that. For instance, for the the trial for the weight loss. We have completed the phase 2B already in China. This is the stage is called seamless, operational seamless. The strategy. So we finished the 2B study.
Was it in June?
It's in, I think we will finish that. Yeah. So actually, the phase 2A study has been finished already. We have obtained very good results. Actually,
what did you find?
We found actually, you see, using for those participants using the F-superglutide alpha at the target dosing, only for 4 weeks treatment. So the weight loss is more than 8 kilograms, let's say it's about
8 kilograms in 4 weeks.
Only for 4 weeks, yeah. But most importantly, you see the body weight loss is only associated with the fat loss, no muscle loss.
Okay.
So, and also,
and
if
no
you
water loss, hopefully.
Yes, you're right. Yeah, since water is very much important. Yeah. We look at there's an index called the ratio of fat to lean mass. Even this ratio is increased significantly after treatment, only by 4 weeks.
Okay.
Yeah, but that's very much important. For those kind of chronic disease treatment, the patient they want not only to feel a very strong or good efficacy, right? You need to give them a very good safety profile. Okay, so you should give them a very a good feeling. Let's say in the context of the side effect. Okay, this one, the one we made called F-superglutide alpha, which is very good safety profile.
How big is what's your estimate? How big is the obesity market?
Obesity market, that would be huge.
In mainland China.
In mainland China, for diabetes patient, the prevalence of diabetes, which is more than 150 million, I think for obesity, that will be several times more than that. For these days, because of the lifestyle, these days, people working too hard, and also, of course, the obesity is usually associated with the people's lifestyle. And so these days, a lot of people, they get overweight and obese. But it should be mentioned that obesity is, it's a disease, right? Which is also cause for many of the other metabolic disease.
Okay.
Like a cardiac disease, renal disease, on the liver disease. Which is also a major cause of the type 2 diabetes. Yeah.
Are you confident that you can get approval for the obesity marketing?
You are right. You see, we have been doing in a very scientific, it's a science-driven company. Okay, so Innogen is a science-driven company. So we are very much, let's say, in the process of the clinical trial, which is very much important. You need a very strong clinical team, right? So for those leading peers, they are very very advanced, pioneer scientists, leading scientists in the field, leading clinician scientists in the field. So, if we review for the trial for type 2 diabetes, we made a very good, very high quality clinical trial. And also we are using the same manner, same attitude for this obese trial. So I think we will get a very good result also, yeah.
Do you have any plans to commercialize your drugs outside China?
Yes. Actually, you see the F-superglutide alpha for diabetes, which actually this we get a market approval, market approval in Macron.
Okay.
And also we find those applications for marketing, like a South Asia country and also some other country.
Are you talking to regulators already outside?
Yes,
outside
we are
China?
finding. We find already. Yeah.
Okay.
Actually, the one
markets?
has been approved. Has been approved in Macron. Yeah.
Okay.
Yeah.
Okay. A lot of attention, global attention from global investors. I want to ask you about what's happening in the industry itself as a whole. Have really taken notice of the innovation and the speed at which the biotech industry in China has been able to get drugs through research, approval, and into the market very successfully. What do you think is going on in your industry? Why suddenly is there such a lot of momentum coming through in your sector?
Yeah, in our sector, actually, the Innogen has been refocusing, dedicated in the disease for those metabolic disease. These are patients with type 2 diabetes, obesity, or fatty liver. Okay, so just very recently, people realize, you see, for those chronic disease, which there's a huge unmet clinical needs. Okay, let's say, since you mentioned what's the prevalence of those diabetes or for the obesity, this is huge. That currently, okay, I think like a scientist or the clinician scientist, they are looking for a very effective and a safe, like manner or option for treating for those disease. So I think that there's a huge potential. Okay, there's a huge market potential. Yeah.
In your mind, you're now a public company, so you'll need to be speaking with investors, media, who might sometimes be a little bit more short-sighted than a company, of course, that is more long-sighted. What is a message you want to send the markets right now that could be impatient, waiting for results, while you're planning for the longer term?
Yeah, actually, the Innogen is a science-driven company. It's a science-driven pharmaceutical company, which we are dedicated to the innovative drug research, development, and also commercialization. Okay, so we are aimed to help to offer those new therapy or those new options for those patients with chronic disease. So we will deliver this innovative and affordable biomedicine for those patients, not only in China and also worldwide. Yeah.
Well, since you mentioned affordable, a final question for you: have you thought about pricing strategy yet? If you do get approval for obesity, how do you plan to compete, of course, in terms of how you set it apart from competitors?
Yes, I think that's a very good question. Indeed, in China, we call there's called a national reimbursement drug list, an idea. So we have been working very hard in participating in the reimbursement negotiation for the 2025 national reimbursement list. Yeah, we making great efforts to achieve to be listed by this NIDL. So I think with with that list, I think that will be much helpful to the patient to increase the accessibility to the patients. Yeah.
Thank you for taking the time to speak with us. Let's speak again once you report earnings, or maybe in between. Qinghua, Wang there, the founder, chairman, and CEO at Innogen. I think the stock is doing okay. First day of trade. Record high. Plenty more ahead. Happy Friday. This is The China Show. Right, welcome back. Lots of things to watch. You might have just seen that, of course, looking ahead to Jackson Hole on the monetary policy. There's a massive meeting taking place, of course, set to take place between Russia and the United States. You have Russian President Vladimir Putin looking to maybe strengthen his rapport with Donald Trump. That's ahead of their summit. Trump, meanwhile, is downplaying Friday's talk, saying a follow-up involving Ukraine's leader will be more important. Have a listen.
We have a meeting with President Putin tomorrow. I think it's going to be a good meeting, but the more important meeting will be the second meeting that we're having. We're going to have a meeting with President Putin, President Zelensky, myself, and maybe we'll bring some of the European leaders along, maybe not.
Joining us here on set is our chief Asia correspondent, Rosalind Matheson, to help us understand what the latest here, what we're hearing from Vladimir Putin, and what do you think the Russians are looking to get out of this?
Well, it's really interesting to see Vladimir Putin is casting this in a really broad lens. He's talking a lot about the economic relationship, the business relationship with the US. He's bringing with him his finance minister, also his chief economic envoy, and really seeking to have the conversation more about the bilateral relationship between Russia and the US, to talk about those opportunities. And obviously Ukraine is a key factor in all of this, and his war in Ukraine, but he wants to be more about resetting the relationship between Russia and the US, because of course, the Russian economy is under pressure. Right. It's on a war footing. It's been all right, but we know there are cracks emerging, and especially around the sanctions side and the pressure that Donald Trump's been putting on Russia over its energy exports to Asia, particularly India, of late. And so his desire is to get those sanctions lifted, to get a bit of easing of the pressure from Donald Trump. That's going to be his number one priority. He doesn't seem that inclined to end his war in Ukraine. He's got no great desire to rush to do so. Perhaps he has to make a gesture. Perhaps he has to agree to that second meeting that would involve the Ukrainian president. But it seems his big priority is actually that direct conversation with Trump about the Russia-US relationship.
And I think on the point you just made, which is very important, do you think then that Donald Trump pushes for a ceasefire of Ukraine? And what would be a good result for Donald Trump here?
Well, it's interesting because, of course, the optics for Vladimir Putin are terrific. He's being hosted by the US leader on US soil. I mean, the win for him is, in a way, just getting the meeting. The risk for Donald Trump is a lot higher. Of course, the last time they had a summit in Helsinki, arguably, Donald Trump was outmaneuvered by the Russian leader, who's very canny in those moments. And so Donald Trump needs to come away making sure that he's not seen as being weak or outplayed again by Vladimir Putin. And that also matters for Donald Trump at home, domestically. He needs to show he's a leader who's getting stuff done and who's not being pushed around. So a bit of risk there for Donald Trump in the meeting. But he's been, as you were noting just earlier, he's sort of walking back expectations for this first conversation. He's saying there may not be agreement on a ceasefire, certainly discussing territory. They're not going to make any agreements about Ukrainian land in this conversation. If anything, that all has to happen at a later meeting. And he's also saying, you know, if you don't, though, move towards a ceasefire, there'll be severe consequences. So he's just saying to Vladimir Putin, I'm aware of what you're doing. I'm not going to be pushed around. But the risk for Donald Trump has to be higher.
We'll have to wait and see. And the fact that they are meeting, of course, is news in itself. Thank you so much for the context there ahead of that massive one coming through. Rosalind Matheson there, our chief Asia correspondent there. And by the way, for our Bloomberg television audience, we'll be live at the summit later today. Keep watching our special coverage out of Alaska at those times coming up on your screens very, very shortly. There we go. That's taking place, if you're watching out of the Asia Pacific, specifically Hong Kong, Singapore, Beijing, that's taking place early to mid-morning, so stay tuned for that. Special coverage. Among the many other things taking place this weekend, there's the Trump-Putin summit, as you were just talking about there. The other big pivot that's taking place this week, China and India. Wang will be visiting India. We'll talk more about that on the other side of the weekend, and of course, the thick of earnings coming through as well in the next week or so. In the meantime, thank you for joining us today. Thank you for joining us this week. Hope you've all had a good one. And I wish you all have a good weekend ahead. We'll see you all on Monday. This is The China Show. Happy Friday.